All right. Well, hello everyone and welcome. Thanks for joining the NAGDA's Trends and Considerations for ESG Investing in Governmental DC Plans. My name is Michaela O'Connor, and I am a Senior Defined Contribution Strategist for PGIM, the investment management business of Prudential Financial. I want to thank you for joining me and our panel today as we dive into the topic of ESG and share with you some new resources recently developed by the NAGDA Publications Task Force. So with me today is Christina Elliott, Executive Director of the Ohio Deferred Compensation Program, James Gorell, Assistant Vice President, Institutional Sales at Nuveen, and Emily Wrightson, a Principal and Financial Advisor for Cap Trust. As we are all members of the Publications Task Force, I have to say it's been a real pleasure to work with all of you, as well as all the other task force members over the last 6 months or so, and I'm pretty excited to have this discussion today. Before we dive in, just a few quick things. We are recording this presentation and it will be emailed along with a copy of the slides to all registrants by tomorrow. You, as the audience, are going to be muted during the duration of the webinar, but please do submit questions throughout the presentation in the Q&A box found in the menu at the bottom of your screen. Your questions will only be visible to the speakers, us, so please feel free to send those along anytime and we will get to as many as possible at the end of the session. And as many of you are aware, if you've been doing a lot of Zoom meetings this past year, there is a chat feature open, which you may use to chat with your fellow attendees during the presentation. So the plan for today is to start with a discussion on why ESG, right? What are some of the reasons DC plan sponsors and industry members are pursuing this topic, and where is demand coming from? We'll then walk through the spectrum of ESG investing and implementation approaches being considered by public DC plan sponsors, sharing some really interesting case studies. And then lastly, we're going to conclude with an overview of the recently released NAGDA due diligence templates that cover ESG, sustainability practices, diversity and inclusion, cybersecurity, and data protection. And then, as I mentioned, we're going to end with a Q&A session. So as a next step, we'd like to get a better sense of our audience's experience with ESG. So we put together a quick poll. So Carly, great. It should be up on your screen. Really just, we want to know more about where you're at, right? And feel free to select all that apply. Are you in the learning and exploring stage? Are you potentially having discussions with your consultant or committee about ESG? Maybe you are considering offering an ESG fund on your menu. And I know, there's not just plan sponsors on this call, but there are consultants and industry members as well. So to the extent that, you can talk on behalf of your clients or what you're spending your time doing or what you're seeing, we'd love to get your input as it relates to this survey or this poll. So Carly, I don't know how long we normally let this up here, but maybe a couple more seconds and we can see the results. All right, so it looks like, the majority of our attendees are in the learning and exploring stage on ESG. And I would say, that is very consistent with what I've seen over the last couple of years. As many conversations that I've had with plan sponsors is really wanting to learn and explore more. Some really good stats in terms of seeing an uptick in terms of inquiries from participants or board members. Also, actively involved in discussions about ESG. And then even 33% are talking with their partners or investment managers. So this is really helpful. So maybe, why don't I begin with a definition of ESG? So E stands for environmental factors, right? Such as the carbon emissions footprint of a company or potentially adherence to environmental safety and regulatory standards, right? S stands for social factors, things such as, what is the inclusion and racial equity profile of the company? Labor practices, including working conditions, even the health and safety of a company's workforce. And G is for governance, right? And these factors range from executive pay to board diversity and independence to the business processes of a company, right? So ESG investing may be referred to as sustainable investing. It could be socially responsible investing. Each of these definitions do have slightly different meanings and interpretations, which we will definitely get into here in a bit. So with that, I'd like to kick off the panel discussion with the first question going to you, James. Can you walk us through the ESG trends that you're seeing and why this topic has continued to build momentum?
Yeah, sure, happy to. Thanks, Michaela. And as mentioned, my name is James Carell. I'm with Nuveen, which is a north of $1 trillion asset manager working across equities, fixed income, and alternatives. And I work in our public plan practice with both defined benefit and defined contribution plan sponsors. So happy to be here with everyone today. In terms of your question, Michaela, it comes as no surprise to the audience here and others who pay attention to financial media that ESG investing has been and remains a hot topic of discussion, of course. A few days go by where publications including CNBC, the Wall Street Journal, don't publish at least one article discussing the topic. And for us, the question here is what's driving this coverage. I'll share the old news adage, if it bleeds, it leads. And I think an analog in this case of ESG is if it flows, it goes. And while I promise that's the last rhyme I'll use today, I want to say that in terms of flows, to put it simply, ESG funds are very hot and getting hotter. You can see growth in demand on the screen here from 2018 through 2020, where net inflows to ESG and sustainable investment funds reached more than 50 billion, or 10 times the amount they received in 2018. So there's certainly a tremendous amount of capital pouring into the space. I'd say, though, it's not just demand for these products that's gathering attention. There's been significant research and academic focus on the ESG space, suggesting that investment strategies which incorporate ESG factors, including things like corporate governance and sustainability initiatives into that strategy's investment process, can actually improve a fund's ability to navigate and manage downside risk. And further, there's research from companies such as Morningstar, which indicates that ESG factors demonstrate a positive correlation with other traditional financial factors, including things like economic moat and momentum. Lastly, and importantly, the question of performance is top of mind. Analysis from groups including Morningstar, as well as the UN Principles for Responsible Investment, has suggested that ESG benchmarks outperformed their non-ESG peers during 2019, 2020, as well as the 10-year period between 2007 and 2017. And at risk of cherry-picking timeframes, which we all know to be a bit of a fool's errand, these observations are at least interesting and thought-provoking for investors to consider as we think about ways to improve returns and manage risk. And so today, the panel assembled, we hope to further illuminate some of these topics and help the plan sponsors on the line answer some of the key questions pertaining to your plan and its participants around, again, does ESG matter to my participants? How can we measure it? And most importantly, is it something that I should seek to incorporate in my plan? So in thinking a bit more about where some of the demand for ESG is coming from and who it may matter to most, the answer for what research is showing currently is that it's clearly an emerging trend among younger age cohorts, millennials in particular. A Cerulli 401k participant study from last year, 2020, found that the age 30 to 39 cohort of retirement investors expressed interest in ESG investments with intent to invest in the near future at a rate more than 3 times higher than the age 60 to 69 cohort, and twice as high as the age 50 to 59 cohort. Further, the age 30 to 39 cohort was found to be actively seeking ESG investment options at more than twice the rate of those older cohorts, age 50 to 59 and 60 to 69. Universally across age groups, there was consistent feedback that ESG options were not easily accessible, which could point to challenges with education and awareness, or potentially, even questions around plan menu design and the availability of these types of investments.
Gotta take myself off mute. That's really great. So Jane, you share some of the more kind of macro demand trends. Millennials, younger cohorts, we're seeing a lot of flows. Now, Christina, as someone who is closer to the individual participant, you're a plan sponsor, what can you say about demand for ESG from a more micro perspective? And how do you expect it to evolve, that demand over time?
Yeah, thanks, McKaylee. And again, I'm Christina Elliott, Executive Director for the Ohio Deferred Compensation Plan. We are a $19.5 billion plan here in Ohio. All public employees are eligible to participate in the 457 plan we have here. And, I think in speaking with peers about this topic over the last 10 years, it seems to be a bit regional. I just came here from California, so this was a topic that we talked about with our peers in California, other DC plans quite often. The plan that I oversaw previously had a couple ESG funds to offer participants, but overwhelmingly, participants are not knocking down our doors to access ESG investing opportunities. It's certainly a topic of conversation in the pension space, which we all know and hear a lot about. But I think that the momentum that James outlined is not going to slow down. And I'm really excited to start the conversation here in the Midwest. I know I'm not starting it, but continue to poke around and see what others are saying here and see what our participants are saying. We do an annual survey of our participants, so we are starting to ask them directly. I think that, it's really going to come down to, do we build it? Will they come? What are the pricing models that will be attached to funds that, we may explore to offer to our participants? And really, part of the discussion that we'll have today is, what's the right type of fund? What is ESG? How does that line up with the values of our participants? And how does that line up with the values and missions of our organizations? And so, we're starting to have those conversations. We're starting to, inquire. And I think for us, I could say that we're really right with all of you in this webinar. We're exploring it. We're starting to talk about it, and hopefully getting ahead of any questions that may come from participants. As the millennials start to get more active in their retirement plan, because we're reaching 40 here soon, they will start to become more engaged with their plans, we hope. So I'm excited for that, and I think that we need to be prepared and have answers when they start to ask us.
Yep, absolutely. So I'm going to go to you, Emily, to round out the discussion on demand, right? So we heard kind of the more macro, we heard more micro. As someone who works, more closely with plan sponsors and committees, how is interest in ESG making its way into the committee meetings or board meetings that you're involved in?
Yeah, sure, McKaylee. So again, my name is Emily Wrightson from Cap Trust. I'm a principal with Cap Trust, and Cap Trust, for those who don't know, is an independent registered investment advisory firm, national firm across the country, working with plan sponsors ranging from corporates to publics. My focus is on public governmental clients, and hopefully I can share some perspectives. And when we get into the case studies, I'll give you a little bit more flavor on what we're seeing out there in the world on specifically on ESG. But to your question, I think it's probably doesn't come as a surprise to anybody on the line that we're seeing a huge uptick in conversations around ESG in our committee meetings, in our board meetings. On the public side, what we're seeing is really a focus, and James hit on this before, around risk mitigation. For those public entities that have a DB plan, and ESG has been discussed already, and focus on, what risks are embedded in the pension, and maybe looking at that a little bit more closely. That's kind of funneling over to the DC plan as well, as many clients want to ensure that the investment philosophy and methodology and process, although they're two very different plans with different objectives, that same kind of value philosophy flows from one to the other. So that's kind of the starting point for a lot of our clients. And I know that many of the plan sponsors on the phone, you may not have a DB plan, or you may be connected to a state DB plan, depending on what entity type you are. But for many publics, that's where it starts. And it also starts with the participant just coming and asking a question or wanting more information. So we're seeing that quite a bit. We see that also on the private side as well, especially in higher ed. Probably also doesn't come as a surprise when you have faculty and endowments. There's a large focus on low carbon coming out of higher ed in both the public higher ed and private higher ed. So we're seeing that quite a bit as well, which has been expected to continue, especially as you were seeing that asset flow. The dialogue is going to continue. And for those clients that, like Christina, who are just looking to align values and looking to explore more ESG and how that might fit into their program, a really good starting spot to just do some due diligence and see, do you want to add a fund, or does that make sense now, later? What type of fund? There's so many different questions. So we're going to try and bring you some of that color during the rest of the webinar.
Great. Anything else to add, James, on demand or access, adoption of ESG before we head to a slightly different topic?
Well, I think, Michaela, I know we're going to spend a couple minutes on it coming up shortly, but one thing that's encouraging, yet highlights some of the necessary work ahead of us still, is the fact that if we were having this conversation among the four of us here 2, 3, 5 years ago, some of the terminology even might have gotten us all effectively speaking a different language. So while I think we've really come a long way as an industry, both from the manager perspective, the consultant community, the allocator and asset owner, and then plan sponsor side as well, we've really coalesced, I think, around a lot of the themes that to the point where we're all speaking the same language in a much better way than we were, as I said, a few years ago. I think there's still some work to do there, but it's encouraging to see the progress that's been made to date.
Yeah, absolutely. I know terminology within the ESG space is something that we'll continue to make progress on. It's interesting when I have conversations with individuals and we're talking about something, and maybe they're talking about a certain type of ESG and I'm talking about a different type of ESG, and we're clashing in terms of what we're trying to actually convey, which actually is a great next kind of intro to the next section, where we talk about ESG investing, right? So I'd like to spend a couple minutes just walking through the different types of ESG investment approaches. And they really fall into 4 broad categories, right? So you have screening, where you use exclusionary screens on an investment portfolio, right? So this could include absolute avoidance of certain sectors or companies, or potentially setting a materiality threshold based on revenues of a company, right? Tobacco, gambling, military weapons, fossil fuels are all common areas where we see exclusionary screens being applied. Now, typically, screening is driven by a desire to better align values, right? So that is one of the kind of core reasons to go with a screening approach. And oftentimes, screening is associated with socially responsible investing, or SRI, right? Then you have thematic investing, right? These strategies look at investing in companies that exhibit certain responsible investment criteria. For example, companies that are contributing to more sustainable forestry or agricultural practices, right? Innovating within the waste and water management areas, or companies focused on health and well-being, right? So aligning your portfolio with companies that really are more on the responsible investment spectrum. And then you have integration, right? So this is where you take these ESG factors and you incorporate them into the investment decision-making process to be able to better identify material risks and opportunities, right? Now, there's no single approach that investment managers take here, and ultimately it's up to the investment manager and the portfolio management team to determine what is considered material and how they're going to act on it, right? One example is climate risk, right? Including, the physical destruction of buildings or the disruption of business operations due to the various climate risks out there, whether it's heat or additional storms, et cetera, flooding, right? So taking that information into account and using it as a risk factor and applying it to your portfolio. Now, the purpose behind integration of ESG factors is to enhance the portfolio, right? To add value for investors because you're taking additional data into account. And then we have impact investing, and this is where there is a clear purpose to enact change. Now, this may be done through the investment process, right? The types of companies you invest in. It could be engagement with companies to become more sustainable and responsible. Really, the goal here is to enhance returns, but also to make some sort of a difference or impact. Now, across these types of ESG investing, as you can see, there's going to be different goals, there's going to be different objectives, and they come with different investment and fiduciary considerations. And so I'm going to pause here and bring James back into the conversation and ask, James, can you kind of build off this slide and share the various ways that public DC plan sponsors can implement ESG into their plans given these types of strategies?
Yeah, sure. So it's no secret there are a number of choices or options for participants, plan sponsors looking to provide these options for their participants, and you can see some of them illustrated here along a couple spectrums of complexity that we'll discuss. And so you can think about a very basic way to implement would involve the inclusion of ESG focused investments as part of the self-directed brokerage window, wherein a participant can seek out and invest in a broader array of options beyond the core plan menu. So really, finding on their own ESG investments and making their own decision to invest through that brokerage window. From there, a plan could go a step further and offer ESG options or even ESG focused target date funds as part of their core plan menu. As we know, having funds on the core menu is going to make them a little more accessible and top of mind to participants, and is likely to drive some adoption there. Going even a step further, plans may consider working with their record keeper and investment management partners to incorporate ESG investing into their qualified default investment alternative or QDIA, which we think is a really interesting option and is just starting to emerge among some DC plans in the U.S. here. And I note that while these options represent potentially increasing complexity for the plan sponsor going from left to right, there's arguably less complexity for the participant as you go along that same spectrum. So the more accessibility of these options for the participant, again, is going to take a heavier lift at the plan sponsor level, but really puts them right there front and center for the participant to be able to easily identify and understand.
Yeah, so maybe I'll go to you, Emily. What types of ESG, whether screening, integration, thematic, that I talked about, are you seeing the most interest when you're working with plan sponsors? And then are you seeing any trends as it relates to implementation as what James just went over?
Yeah, sure. So I think it comes down to the client and what their value is and what they're focused on. But for a lot of clients that are just looking for maybe a broad ESG, they're interested in ESG, they're on board with it, they'd like to include it, they probably go with most likely with the integrated approach. They want, the ES and G, they want everything, they want that approach. And they are likely choosing an equity fund and a fixed income fund, or a balanced, if they're just looking to do a single fund, they'll choose a balanced option. So a 60-40 or, all in one option. And the idea really is to give participants that are interested in those ESG options the ability to make a complete portfolio. So don't just offer one equity fund or one bond fund, offer the ability for a participant to have both so that he or she can make a portfolio that makes sense from a risk tolerance standpoint. So that's what we're seeing. That's very common. Other clients, we're seeing a little bit of a different approach where they may have a specific value that they want to screen. They may have a specific goal or something they want to screen out. Like, for example, I spoke about low carbon before. I'll use that one as an example. You have a participant or participants who are very focused on climate change and a low carbon. And so a screening process that removes, reduces, screens out negative, positively, those kind of carbon polluters from the fund could be very appealing. And we've seen that for many clients that will take that approach. So I would say those are the primary two that we're seeing across clients in the public space.
Great. Christina, as a plan sponsor, can you share how you're approaching the topic of ESG with, the Ohio Deferred Compensation Program? You can even touch on your history back in California, but, what are you doing with ESG?
Dang it, I'm on mute. Okay. I mentioned earlier that, we're very much in the beginning stages of this conversation. And one thing that has come up since, this topic, I became aware of it 10 years ago, is fiduciary duty. So how do we approach this and not lose touch with our fiduciary duty to our participants? And what James and Emily have outlined are critical things to consider and ponder as you start the conversation. And so I'm feeling like it's the best place to be right at the beginning. We can start wherever I report to a board. So where's my board on this topic? I mean, there's going to be a lot of different ways that I can approach this. And most importantly is, how does my board feel about this? I also mentioned, aligning with the mission of your organization, the core values that your organization may have. And obviously your board or the governing body, the committee, whatever you call it, is establishing those values. And so I, think board education is a huge component. Having conversations with your staff that may, get questions from participants out in the field if they're doing field work, just preparing them to be able to, gauge a conversation and have some sort of answer around ESG and the principles and the methodologies that are associated with the topics. There's regulatory limits, there's things happening on the national stage, obviously. Whoever is, our president can have an impact on how this is governed and the various fiduciary liabilities that we need to be considering. So it's not a light topic, but it's an important topic. Again, based on the research that James outlined, what Emily's seeing with her clients, this is not going away. And it just really comes down to the process in which you roll this out and the conversations that you have. And the data's here. When we first started talking about this, or when I first started talking about this 10 years ago, there really wasn't much data to show that this is good for participants. And now the data's there and you can't ignore it. So I think we're in a really good space to be able to start these conversations, as I mentioned. So that's where I'm going. I'm going to start with my board.
No, that's great. I guess maybe from a behind the scenes standpoint, I know you've been talking with your partners and your investment managers to get a better understanding of what they're doing. Could you share a little bit about kind of that process and what you've learned and what are some of your intentions on that front?
Yes, and I'm excited to talk more about that in a little bit of what that's evolved into. But, you know, part of what I consider when I'm talking to investment managers that, you know, we partner with in running the money and managing the money of our participants is what kind of companies are we doing business with? Do they have good governance of their, you know, of their firm? What are the social impacts they have on the world? You know, do they treat their people right? They may have rock star investment managers, but do the researchers hate working for them because the turnover is so high? I mean, I think these are really important questions to ask. They're not going to say we have a bad culture, of course, but my approach has been to actually ask them these questions. What do you do? What are your governance policies? What is the, you know, D&I makeup for your firm? And what do you value in this space? So really just figuring out if the folks that are running our money and managing our money, you know, how do they have an impact in each of those categories? And so we'll get more into that and the logistics of that here soon, but that's how we can start to have a conversation, as well as in a way holding our partners accountable to the same things that they may be managing on one side of the house or the other.
Yep, exactly. So I wonder, James, based on what Christina was just talking about, have you seen an uptick in requests from either plan sponsors or consultants regarding, say, Nuvine's sustainability or diversity inclusion practices? Be interested to hear your thoughts there.
Yeah, absolutely. So I say both, you know, within the public plan space on both the defined benefit and defined contribution side, we're regularly asked about the very topics that Christina just highlighted, right? And while, you know, I'll go back to the same comment I made earlier of, you know, thinking back 2 to 3, maybe 5 years, perhaps there would have been a question to, you know, maybe a section within a due diligence questionnaire about some of these things. Now there's a fully dedicated, you know, due diligence questionnaire focused solely on these topics from many plan sponsors. So the importance of these issues in terms of due diligence requirements from the manager, I think it's grown significantly in the past few years. And that actually, you know, I think is really what brought the group together here, was to help, you know, the DC plan sponsor try to get their arms around, well, if I don't have a good process for evaluating these attributes today, where do I start, right? And so that's, you know, what the working group was built around to help plan sponsors evaluate these attributes when they're working with manager partners.
No, absolutely. So, Emily, I'd like to come back to you and dig a bit more into how you've seen plan sponsors approach ESG and DC plans. I know you have a few case studies to share, so I'm going to hand it over to you to kind of walk through those and share with us other ways that plan sponsors are looking at ESG.
Perfect. So we have 3 case studies for you today, and they're all different, you know, different examples of ways clients have approached this, the methodology that they've used. The starting point is a little bit different, but I think we've got the time. I'll walk you through each one. In this first case study, a participant requested an ESG fund, went to the committee, went to the chair, requested an ESG fund, wanted specifically a fund that excluded carbon as much as possible. This was the focus. You may have this, you know, you probably have this participant sitting in your workforce already. So in this situation, the plan sponsor really wanted to do their fiduciary process, wanted to take things slow. As you know, anytime a participant requests a fund, you don't necessarily jump and put that fund right into your plan. You do some work and some research around that. So that's what they did. We helped create a survey to push that out to the participants and really wanted to understand what was the focus here. Was this just a one-person thing, or was this a broader desire? Do people really understand what ESG is? Is low carbon the right focus? Should a more broad ESG perspective be taken? So through that survey and the results of that survey, the client ended up identifying that they did want to go with a low carbon focus, and we screened out some funds for them. And again, through that due diligence process of watching and making sure that the managers were strong and the investments had good long-term performance and good risk-adjusted returns and all of those metrics, as well as met their fee requirements. Once that period of time had passed that they'd reviewed, they chose some funds and added them to the array. And that really wasn't where they stopped, because anytime you put a new fund in the array, especially one with an ESG tilt, you really want to take the time to do some custom communication education around that and help people understand what the fund is, how it works, how you should use it. So they did a broad campaign around that and prepared some custom communication materials that were pushed out, as well as on the website, did some group meetings trying to engage participants more and really use that as a launching point to try and get people in the plan as well and do all of those other good things that you want to do with your retirement plan. But this is just one case study example of client number one of how they approach the ESG approach. So on the next slide, we'll talk you through a slightly different tilt. So this was a state system that has a requirement to take a look at ESG and D&I and have it be considered in the investment offer. Doesn't mean that they have to include it, just means that they needed to review it and have some consideration for those funds. So through this process, went through a lot of discussions, talking on again, this is for a DC plan, but client also has a pension, and so they were very aware of, what does that look like on the pension side, wanting to align the DB and the DC to, have the same investment philosophy in a sense. Ultimately, they decided that they wanted to build their own ESG fixed income fund, and that would serve as a complement to a passive ESG equity fund. Again, the idea I mentioned before that a participant may want to build an investment array that was fully ESG and had that bond and stock or equity component to play around with. So through that process, went through due diligence on ESG managers. Several managers were reviewed, considered, and they ultimately hired a minority-owned investment manager that they partnered with to build this ESG fixed income fund. Similar to the last one, anytime you put ESG in, definitely recommend doing some extra communication education to ensure usage of the fund and understanding and good practice there. So that's what was done for case study 2. And finally, on case study 3, this was a totally different approach because this client didn't have a participant come to them and request this. They weren't mandated by their state or by law to take a look at things. What they did was they really wanted to understand and align, understand what the under the hood of their investments for their retirement plan, and take a look and see how that complemented their values. So they were kind of preparing for possible questions from their participant base, and they wanted to look at the full array. So we worked with them to create a prop screening process to take a look at everything. And detail the fund's exposure to various risk options. There are 17 that were used. Again, this is in conjunction with the UN SRI principles. So it included things like fossil fuels, weapons manufacturing, board governance, fur, all of the things that you would want to take a look at to see, maybe they had some ESG investments already, but they had quite a few that were just run of the mill, your standard investment options, and they wanted to see where they fell in that. And they're going to really use that information to, in the future, if participants come to them and ask questions, they will have this in their back pocket to be able to say, yes, we know what's in our plan. We know what kind of risks are there. We know which funds have lower carbon exposures than their peers or their benchmarks. So part of it was education for the committee and the board. Part of it was to arm them with some tools in the event someone started to ask. And finally, they're really going to use this information to start to align, their investment options in their DC plan with some of the goals of their organization. Not immediately, the investments are doing well, performing well. They're not looking to strip out anything quickly, but it's really to say, oh, hey, wait, this is important to us, and this fund has this huge exposure to, I'll just pick weapons manufacturing, and that's not in alignment with what we want to, where we want to be. So we may want to swap that fund out if it comes time that we want to go a different direction. So little bit of a different tilt on that case study 3, but they're more in the mindset of they want to be proactively looking at, what's in their program, where are possible risks sitting, from a financial standpoint, from a risk mitigation standpoint, and also from a value standpoint. So that was an interesting one, wanted to share with you all.
Now, these are all really great examples of the ways that plan sponsors have explored the topic of ESG, whether, Christina, it's getting to know your partners better, or Emily, all of the examples that you just shared. I guess the biggest takeaway that I see here is that there isn't one way, right, to explore and implement ESG. And I also think we're in the early innings of ESG. And so as more data becomes available, we're definitely going to see some continued evolution within this space over time. Before we dive into the Q&A, let's shift our focus to NAGDA and the recently released template questionnaires. Christina, as I know you're very much involved in this initiative. And so I know I had you give a little bit of a preview to what you wanted to say here, but share with us how these templates came about, how plan sponsors can use them, and anything else you think is important.
Well, you're being modest because you were very much involved as well. I actually worked with McKaylee when she was our consultant in her previous life, recent life. And, we just started to brainstorm, how we wanted to approach investment manager meetings. We all do them. What are we getting out of them? It's just very performance focused, methodology focused, which is obviously critical. But what else can we do in with that time with our partners? And so we worked together to develop a questionnaire. We've been calling it the OG questionnaire because it's kind of where this came from. And it asked a variety of questions around diversity, equity and inclusion, cybersecurity, ESG, but it wasn't about what they offered in as a fund. It was about them as a firm, which I mentioned earlier. And, really what they're doing in this space. It's a new conversation. Again, I've said that a couple times here in Ohio. So really making sure that I understand the values of my program along with the values of our partners and seeing if they line up, and so the questionnaire has been a great way to gauge that. ESG in particular has been a really interesting conversation, and I not to jump ahead to questions, but I do see a really great question about if ESG performs, if it shows that it's valuable, if it shows that these types of principles and methodologies within an investment space work, will this no longer be an issue because it's going to be incorporated into what we do as investment professionals in the future? And to Mike Webb, I say, I think so. I mean, I can't predict the future, but I think what James and Emily outlined is interesting to show what may happen. And I think that if we're looking at value and growth and looking at companies that we want to invest in, I think that a valuable a company that, you're scoring for value, well, how do they treat their people? What is their impact? Are they sustainable long-term? It's really these are the types of questions that investment professionals are already asking when they do their evaluations and their research. So sorry to kind of jump ahead, but I would say the answer to the question is I think probably yes. I think that the future is we're going to need to start to worry about whether companies are around long-term or short-term and what their impact on the global, marketplace is. So that was the approach I took with my partners within not mine, but Ohio's fund lineup here. And it's been really, really informative. It's built really good. I think that these conversations have built great relationships with all of my investment managers. And the purpose for me is to show that this is important to me. These are the values of our organization, and do your values align? And, what's our future together? and I think these are really good questions to ask, and was foundational for what we're going to review with you right now. Am I supposed to review it?
I think we'll just do like a quick overview.
Sure.
So, you know, Christina and I came to NAGDA, and we worked to put together a task force of, well, actually NAGDA really helped do that. Carly was very instrumental in that, and putting together a task force of plan sponsors and consultants and investment managers. And I have to say, the collective and collaborative effort to, you know, put our best thoughts together for these questionnaires was quite impressive. You know, we started off with what Ohio had developed, and really they transformed into a really great template for individuals to use. And really the goal is for you as a plan sponsor or a consultant or an investment manager to take these and use them how you want, right? This is what we put together, but you know, maybe not all of this is important to you or interesting to you. So take what you seem to be, you know, or is valuable. And I think for the investment manager community, these are the types of questions that plan sponsors are going to be asking you, right? Consultants, you know, looking at your own questionnaires, how can you enhance or improve them based on some of the information here? So I think there's a lot of application out there. I don't know if there's anything else that anybody wants to say as it relates to these questionnaires before we dive into the Q&A.
I'll add that, you know, even though we work to develop this together, I'm even going to be taking these and probably slicing and dicing them a little bit and customizing them for our program to use in the future. So I think that even if one question is valuable, I'm sure everyone's going to find some use for these tools. So,
yeah, absolutely. All right, well, let's get into the Q&A session. I guess, Christina, you know, you had already kind of addressed one of the questions in terms of, you know, if ESG truly enhances fund performance, could this become a moot point in a decade or so? So I don't know if Emily and James, you have any additional comments on that. I definitely agree with where Christina was going, but would love to get your thoughts as well.
I think Christina addressed it nicely. The only thing I'd add is that, you know, specifically within the phrasing of the question, it asks if ESG will become a moot point in a decade if everyone's doing it. I think rather than thinking of it that way, that's a scenario where ESG has become table stakes, right? And it's a necessary factor for everyone to incorporate, right? If it does, you know, indeed truly enhance performance and you're not incorporating it, you know, you're going to fall behind the rest of the pack. So again, rather than a moot point, I think it points to ESG potentially as a necessary ingredient for a successful investment strategy.
yep.
Moving on, this is to you, Emily. For case study 1, how closely did the survey align with actual participant elections?
So thanks for the question. It's a really good one because a lot of people will say, yeah, I want to go to the gym. I'm going to get a gym membership. And then they get the gym membership and they don't actually go, right? So we saw a little bit of that in the survey response. The individuals that were gung-ho and said, yes, we want this fund. Yes, we're interested in it. And yes, we'll use it, used it. But I will still say that the pickup rate on these two new investments that were added in is low. And a lot of that is just because there's so much money directed in that particular plan to target date funds. So I think James had commented on the fact earlier that ESG focused target date funds is something that we're just starting to really discuss in this country, and there's more options available now, but that getting participants to take action is often a challenge. We certainly did see more enthusiasm for the fund and then less action there. So hopefully that helps answer your question.
So here's a bit of a long question, but for those plans that do already offer a handful of ESG funds, where do you see gaps or opportunities to add to that lineup? I think, Emily, this kind of goes to what you were saying is most common in terms of ESG funds. Is there any demand for other asset classes or funds, whether it be asset class, it says cap and wrapper, I'm not entirely sure what that means. But, and then a second part is for those plans that currently have no ESG offerings, what are the foundational funds they should consider adding? Oh, cap, market cap, got it, yeah. Okay. James, do you want to maybe start with that?
Yeah, sure. So, going back to my comment at the outset about the significant attention in terms of flows in these various ESG focused investments, with that, for better or worse, comes significant product development from the investment manager side. And so you've seen no shortage of product development, product launches over the past few years to help meet demand in every facet and category, that it comes from, right? So if you think about, Emily mentioned a couple of the common examples for ESG inclusion within a plan menu, typically being something like perhaps a broad-based equity strategy, maybe a broad-based fixed income strategy as a complement, or perhaps a balanced offering that combines those two. You think about the typical building blocks of, an overly simplified portfolio that might include some cap diversification into things like mid cap, small cap, for fixed income, perhaps into things like high yield, the different facets that you can explore. I'd say that, there's a manager out there doing an ESG version of just about every one of those things. So if you're looking to go beyond, the simple things like a balanced or a traditional equity or fixed income fund, the sector options are out there, the different, the question alluded to different cap spaces. There's no shortage of ways to implement given the innovation of product that's occurred in this space.
One more question, well, actually a couple more questions, but another question. If a plan has low interest from participants in ESG, and the plan also has a brokerage window, what are the fiduciary indications of telling participants they can use the brokerage window, considering that retail funds will have a higher internal management fees? Anybody want to take that one, Emily, maybe?
I can start here, and Rod, thanks for your great question. I'm used to them because we work together, but Rod, I think you ask a great question, and obviously I'm not an attorney, so this is not legal advice, but the brokerage window is commonly used for those participants that want to go above and beyond outside the core array. And so for a plan sponsor that is looking to keep their investment array very concise or, at a reasonable number, because you always want to watch how many funds you're adding, offering a brokerage window could be a great opportunity. But I think the challenge there is that the person really has to want to go and do it, and they want to go and they'd have to do their own research and take all of those steps to do that. I don't, are there fiduciary implications around, telling someone to use them due to higher fees? I think you're probably okay. It's another option to them. They have to check the box that they understand that this is outside the core array, that they're responsible for additional fees, that these investments aren't monitored, all those good things with the brokerage firm. But if the DOL comes back and says, I know that there was a notice, probably 10 years ago at this point almost, where they came out and said that fiduciaries would be responsible for monitoring investments in the brokerage window, and that quickly got pulled back. Who knows what they might look at next? So you always want to be considering what they may do. But I think you're okay to direct someone to a brokerage if you wanted to, if that fund was not available.
I know we only have a couple minutes left. And so I want to kind of go back to the NAGDA templates a little bit, and maybe I'll direct this to you, Christina. what is a plan sponsor supposed to do with this information, right? Like, how do they actually use the information in these templates? Or what are you planning on doing kind of year over year, or doing it once, et cetera? Maybe you can talk a little bit more about that.
Yeah. So when we first started to have these conversations, it really, I didn't put a lot of parameters around the conversation. We basically, RVK sent the questionnaire out to each of our investment managers that we had scheduled meetings for, and said, Christina would like you to answer this, basically, and then didn't say much else about it. And that was purposeful because I was initially just curious to know how they would react, honestly. And, if they came back and they brought their D&I officer, or they brought their ESG managers, and, every single partner that we had a different reaction to it. And really that was kind of the baseline for the conversation, because every investment manager, I don't want to say valued it more or less, because that's not necessarily fair to say, but it's a different conversation with each of them. So really it was a value statement to them as an introduction for myself. This is important to me. I value this information, and I want to see how you react to it and what you do with this questionnaire. And, there's a lot of things that you can pull from it as a plan sponsor, and you can make some assumptions around, what they're doing in each of those categories, and, make a decision around what that means to you individually, of course. But what I do plan on doing is I'm using it as a baseline. I'll be asking the question annually, so it won't be a topic of discussion for each of my meetings with my managers. I like to meet with them at least twice a year. And then one of those will be a conversation around where they are in each of those categories. So how's your cybersecurity improving? What are your D&I stats? How have they improved, or how are they lagging? What ESG research are you doing? How's that being incorporated into your methodology? Kind of back to the point of, this is going to become an important part of what you do as an investment professional. So that's my plan. I plan to just kind of use it as a conversation and benchmark growth in each of the areas, and how they're improving, or what they're doing, and how they're innovating, and just getting that conversation going, and then using that information as well to educate my board around what we're learning from our partners. I hope that answers the question.
That's great. That's really great. Well, we are 1 minute to the top of the hour, so I just want to say a few things that I wrote down based on the discussion today. So some key takeaways, I would say, while ESG and sustainable investing have been around for a while, as a broader trend within the DC space, I would say we're still in the beginning innings, right? Demand may come in different forms. Plan sponsors should at the very least be prepared to answer questions and respond to inquiries. Aligning values versus enhancing value versus making an impact, right? As a plan sponsor, where does your overarching goals and objectives fall? I think that's a good question to take away. There are also several ways that plan sponsors can explore and implement ESG, right? Whether it's through investments or engaging with partners, similar to what Christina is doing. And then lastly, I would encourage you to download the NAGDA template questionnaires, review them, learn from them, tailor them to your specific needs. With that, I want to thank Christina and James and Emily for their insights today, and to the audience for tuning in and asking questions. I think we got to all of the questions, but if not, we will be sure to follow up with you and have additional conversations. With that, have a good rest of your day, and hopefully we can connect soon. Thank you.